All right. Good morning, everybody. Good morning. This is Signet with the Bullish Bears. It is March 2nd, 9 o'clock in the morning. Hopefully, you had a good weekend. Got a little bit of a list here for morning gappers. Some old familiar faces that we see again and again on the gappers list. There was a little bit of news over the weekend with the coronavirus, Apple downgrades and then upgrades, and a lot of the discussion right now seems to be focused on pricing in a rate cut. Two of them, as a matter of fact. One talked about for this week, and then the regularly scheduled FOMC meeting where they are anticipating another rate cut. A lot of the other central banker countries have already initiated rate cuts. So the markets are pricing those in. Should be an interesting week. Hi, Richard. How you doing? Anything you're interested in looking at this morning? Of course, a lot of the big names are all going to be correlated. So finance got whacked pretty hard last week. Well, it's easier just to say what didn't get whacked last week. Uh, Gold is starting to rally back. So one of the things that was really getting people confused, uh, I seen a lot of discussion on the weekend, was the fact that gold had gone down when normally that is a safe haven. When the reality is the banks got caught uh, in that rout last week, and they owed so much money they had to sell their own gold to cover their debt. So not hard to figure out what happened in the gold when you think about the fact that they needed to pay their bills. And of course, that ended their week. And now here we are looking at gold trying to get a little recovery there. Now, in about 7 minutes, I'm going to have to go over and fire up the live stream chat room at the Bullish Bears website. If you have not yet gone over there, come on by. It's 14 days for free. And one of the things that I continue to point out to people is that it is cheaper for you to buy an education in trading than it is for you to lose because you don't have any education in trading. So last week, there was people in my Discord chat room who had lost $30,000 to $50,000 in the last 3 to 6 months. Now, those are staggering numbers of loss. And when I asked them what education they had, or where they go to learn anything, they didn't have any. I don't understand why somebody thinks they can trade this market without any understanding of the marketplace whatsoever. But uh, if you're going to look at money flowing out, I believe that it would feel better and be more beneficial in the long run to take some education than to take continuous losses without any way to understand how to stop it. The Bullish Bears is a community that focuses on education and on trades. So we call out a few trades a week on the average, more than enough to pay for the subscription and membership. And then from there, there's also the education side. Swing trading, day trading, options, futures. I believe we're going to be getting more into Forex soon. So something worth thinking about. Come on by, sign up for the 14-day trial. And if you don't want to stick around afterwards, well, you didn't lose any money because it was a free trial. Can't argue with free, right? It's really frustrating to see people take losses, and then when I ask them where they had learned whatever it was that they were doing, oh no, they didn't learn that anywhere. Did you backtest your strategy? No. So you didn't know that it would even work. You just tried to put money on it. Yep. That's a bad way to do business. A lot of biotechnology again. Not a lot of surprises there. The safe haven markets last week, there was no safe haven markets last week. There are some news coming out on a few different stocks. One of them, Gilead Science, looks to be buying FTSV. And so FTSV is up in the pre-market. We need to swap these around a little bit like that. Now, when it comes to earnings, I don't typically try to anticipate market direction. Instead, I trade either an iron condor right before they announce, looking to keep the market contained within the window, or I trade the volatility that comes out afterwards. There seems to be more edge in doing that than trying to pick direction, especially considering nowadays, well, not even nowadays, especially considering the fact that you can't anticipate what their forward guidance is going to be. And so there is absolutely nothing on the chart to give you any hint of which damn direction the price is going to go. And if you don't have any hint or any edge, then trying to trade directionally at earnings is like going to Vegas and betting on red. I'm not much for gambling personally, so I just look to see a market do what it typically does. 4,000 markets report earnings, and most of them have a little bit of volatility, whip around a little bit, and then they settle right back down where they were again. And that's why the iron condor works so well. Plus, they get vol crushed, and we can anticipate a vol crush, unlike trying to anticipate market direction. So you just put on options trades that make money when volatility goes down. It makes perfect sense to me. At the very least, you have the opportunity to get half of the trade right. Even if you get the direction wrong, you still get enough from the vol crush to make the loss not hurt so bad. Makes sense? Thought I had an earnings here. Guess we'll run with that. I changed my system around over the weekend, and I'm not yet comfortable with the new way that I've got it set up. But I'm already thinking that I don't like it. Hey, you shoes. So what we need to do is get some intraday here so that when I jump into the lower time frames, I don't lose everything. Save style. Anything in particular you're looking at this morning you want me to take a peek at? That seems to work pretty good. All right, one more minute, and then we'll have to go over and load up the live stream. I was waiting for that. CODX. Yeah, a lot of talk about that one this morning. Taking that out onto the higher time frame. Not a whole lot to the left. There's 2 years. You still see there's nothing here, nothing to get tangled up on. Let's take it out a little bit bigger. There is absolutely nothing there. Style. CODX. Nice run up in the last week. Friday gave a little bit of it back to structure. And now a little pre-market activity. Gonna really want to see this hold that 15. Why does it say 15 and 13 up here? Thinkorswim is being a little goofy this morning. Either way, it needs to hold this structure. There's been a lot of talk about Thinkorswim failing to do what it used to do. I think that when they got bought out by Schwab, I think Schwab kind of cleaned them out on their servers. It's it's a little disconcerting to say the least. All right, I got to jump over and fire up the live stream in the Bullish Bears chat room. Good morning, everybody. Good morning. Let me get a sound check, please. Thank you, thank you. Hey, you Creed, Bear. All right, everybody. Welcome to March 2nd, 2020. We was just looking at CODX. FTSV was in the news this morning due to Gilead Sciences, so perhaps keep your eye on that one. Could see a little bit of activity. The Gapper list, pretty decent Gapper list. Some familiar faces in there. A lot of news coming out over the weekend. Some upgrades and downgrades. Almost got whiplash from all of that. Gold seemed to have picked up a little bit. There was discussion over the weekend of why gold went down when that's normally a place where people funnel their money in a uncertain economy. And the big takeaway seemed to be that the banks got caught and needed to liquidate. They had to sell gold to pay for their losing trades last week. Imagine that, huh? We are looking for some move in volatility. If you was a geek and crawled through the volatility over the weekend, you may have noticed that almost every single thing out there had an elevated volatility. They are pricing that in. And so if you had not yet made a trade that captured volatility, you're out of luck. I did look around for things that had not yet gained massive amounts of volatility, and there are a few opportunities to perhaps try to put one on, but it won't pay out as good as what you could have had last week, because now the market makers are pricing it in. No, Robert, I looked at the Trade Ideas screen share as well, and I never got the meeting to open. It's a little bit of that Monday morning gremlin, I guess. So we did put on a short position in the VIX last week. Covered that Friday in the live stream. If you don't understand the way that the VIX trade strategy works, we put on a skewed butterfly or a broken wing butterfly, whichever way you want to look at it, because of the way that the options pricing is in the VIX. We went with May, and we skewed the trade in such a way that if the VIX tanks, then our trade will keep the credit that we had collected to get into the trade. Not a bad trade in the long run. If you look at the VIX historically, when we get to these levels, you take it short. There's not much discussion on not taking it short. The problem that most people end up with is they don't understand options very well, and the only thing that they can think of to do is to put on a credit spread. Well, if you put on a credit spread in the VIX, when it's at this levels, you're going to risk, say, $240 for a $10 credit. Nobody wants that trade, right? So what we did is we put on the skewed iron condor, and the idea there, or the skewed fly, is like a broken wing. If price fades back down to that 23 level, then we'll hit the sweet spot and that trade will really pay out. But if it just completely tanks back down into the teens, then we just get to keep about half of the width of the entire trade, which is a heck of a lot better than collecting $10 in a $2.50 wide trade. That might still be a viable position that you can put on today. And if you're a member of the Bullish Bears yearly subscription service, then you should be able to have access to our private Twitter account, which is where I posted that trade. So you should be able to find it, reconstruct it this morning, and everything will just be all well and good. Should be applicable even in today's marketplace. I don't know if anybody's reached out to Dan or Lucian on the live stream trade ideas screen. I turned it off when it wasn't connecting for me because I had to fire up the screen here and one more thing running. I just wasn't interested in it. So we were talking this morning about the futures market. On the big picture, I'm really looking to see 2,500. I've got it marked out here. I own what I believe. This is what I believe. I can be wrong. We've all been wrong. I'm sure I will be wrong again, but that's my target. 2,500 on the S&P before this is all said and done. As far as I'm concerned, any rally is nothing more than shorts that are covering, getting risk out, getting profits before we continue this march lower. That's just how I see it. Yeah, Arjun, I'm the one talking. My name is Signet. Good morning, everybody. And the live stream should be in the archives. So you can go back and watch Friday's live stream and see me rebuild it. You can watch that to understand what the trade is and how it works. And if you are a member of the Bullish Bears, as a yearly member, you can find the trade rebuilt on Twitter. Coffee. One of the things that we were talking about also over the weekend are the companies that have come out and lowered their forward guidance. Recognize this fact, everybody. The supply chain disruption from China has not yet affected our marketplace because there are a lot of companies who have not yet lowered their forward guidance. And when they do, they're going to get punished. Apple has already done it. And Apple came out to say that they were going to rebuild their supply chain from scratch. So they were going to find a new way to get supplies that had a workaround for the China problem. That has not happened in a lot of other companies. And when they do, the reverberations through the marketplace are going to be felt. Recognize that gold is not the only thing that's not acting right. And we are still in backwardation if you look at the VIX futures as well. Remember that contango is normal. It's what we expect to see. And backwardation is when we are no longer in contango. That's not just for VIX futures. It's anything that has a price with a date, right? There has been Fed talk about the rate cut in the March meeting, but now they're talking about a rate cut for this week and another one for the March 18 meeting. So depending on how today really kicks off and what happens through the first part of the morning, we could get some answers on that rate cut. They are pricing in, central banks are pricing in rate cut all around the world. Depending on the country that you're interested in check the news. Quite a few of them have already come out with cuts. They didn't wait. They're firing their guns early. Well, I see you guys talking about coffee. That's just coffee. Please be very cautious in this market. Get profits. There's nothing wrong with locking in your profits and even just getting completely out of a trade and calling it good. The idea, take something like SPY and look at the elevated volatility in here. Suppose that you traded puts last week and you're up quite a bit, and you should be, because those puts expanded in value when the implied volatility expanded. Okay, so you didn't just make money in those puts because price went down. You made more money in those puts because the volatility expanded with your puts. Now, here's the important point to keep track of. If the market makers get a whiff that this market is going to rally, they're going to crush the hell out of this volatility. And when they do that, the value of your puts are going to go straight down. Okay, it won't take much price movement to the upside at all. What it will do is, if this volatility goes back down, your puts are going to get crushed in value, even with just a very little amount of upward movement in price action. So keep that in mind. Your puts, if you sold some or bought some puts last week, if this thing starts to rally even a little bit, the market makers are going to do this. So using a stop or anything like that is not going to be effective. Limiting your risk in the trade through price is not going to be effective. Use the volatility from right here on the options chain to set your alerts. Okay, I don't know what series you might have traded, but you can right click on Thinkorswim and you can set alerts for implied volatility or delta or whatever it is that you want to set your alert on. Use that to protect your profits rather than trying to use price action. Enough of the geek talk. I know so many of you don't care about trading options. It's not your jam. Hey, I get it. PMI manufacturing does come out. That's absolutely true. I heard that China had the lowest PMI manufacturing ever in the recorded history of PMI manufacturing numbers. That was interesting. So here on Thinkorswim, you can go to the calendar, set it to today, just click Show All, and then turn them all off and click Econoday. From Econoday, you got PMI manufacturing, construction spending. 15 minutes later, the ISM manufacturing, and really that's it. The auctions, they're nothing for us. We don't care about that. So that is where you find that information. With the highly correlated market, it will not surprise me to see the way that whatever you want to look at, they're all going to be looking about the same. So when you find one that's standing out, recognize it for your trade opportunity. For me, I like to trade finance, so I'll load up a chart with a bunch of credit cards or a bunch of banks, or there's the bell. For other people, maybe they want to do weed stocks, or they want to do the chip makers like AMD and MU and HP. Whatever it is that you're looking to trade, find something that correlates with it so that you're not just staring at one single chart, right? With the bell, we typically give it a good 5 minutes to let price discovery work itself out. I like to do that using index watch. The Dow is the easiest one since it's only got 30 markets in it. Oftentimes you can find a bit of divergence, but there is none to be seen here this morning. 28 issues moving to the upside, all the capital moving into the market. So the Dow's a bit boring. Let's see if we can find something in the S&P 100. Here, 90% of the S&P is moving to the upside, and most of the capital flow is also moving to the upside. Comcast getting whacked this morning. Bank of New York Mellon, Bank of America. So the financials are getting tapped a little bit. Starbucks makes sense. Anything that involves crowds going outside. PayPal a little bit in the red. All right, this is turning around pretty quick. Let's go see what's happening in the NASDAQ. So here we are with the NASDAQ 100. We've got 70-30 and more money coming in than going out. Again, no divergence, no surprises here. Look at what's in the red and what is moving lower. Marriott, that would be the consumer spending on the frivolous side. Your cruise lines, resort hotels, things of that nature. Not a surprise. That's a risk-on asset. Pharmaceutical. Odd to see that one down. American Airlines. Quite a bit of news about the airlines canceling flights and lowering their forward guidance. Fastenal. Expedia. Nestle. Last one to look at before we get back over to the Russell or to the Dow will be the Russells. The Russell 1000 is as small as it gets for us. We don't try to jump through the names that are in this list, but instead we just look up here. Whack off the back number so that you're looking at 72 moving to the upside and 25 moving to the downside, and then keep your eye on the capital. Again, we have no divergence. This is all pointing to a risk-on market, which I have absolutely no trust or faith in. I haven't been shy about where I believe the S&P is going, and I can be wrong. It's definitely happened before. I see that Dan fixed the Trade Ideas screen share, so for all of those members who have access and want it, it is back up and running again. Thank you, Dan. Totally appreciate it, buddy. Let's take a moment here. This is really my comfort level. It comes from looking at the Dow and breaking things out into what is green and what is red. Setting it up like this gives you a quick visual on the sectors that are helping or hurting or running sideways. You can see it as well. I've shared this quite a few times, but if you don't have a lot of screens, it can make it difficult. So this graph is tracking 4 markets, 4 indexes: the New York Stock Exchange, the NASDAQ, the S&P, and the Russell. This is cumulative tick The zero line shows where we cross from accumulation into distribution or vice versa. And what we look for here is market sync. Market sync is identified with the green lines or the red lines, red dots, green dots. When it's white, the market is not in sync. Sync is just like what it sounds like. You want to see them all moving as a group, all moving up or all moving down. The one thing that we use this for, not the only thing, but one thing, is watching the Russell. A quick Russell crossover can give you a heads up or a warning. It doesn't matter which time frame you want to set this on, a 1 minute or a 5 minute, but whichever one that you set it on, stay consistent with it. Don't swap it back and forth. From that, we back out to the sectors, kind of get an idea of what is going on, what is carrying our market or holding us back. Keeping track of the sectors can give you a heads up on if there is any follow through in the marketplace. The top three that you see here on the left side of the screen, these are risk on assets. The middle three are midline, and the bottom three are risk off or defensive. These aren't the only sectors to watch. There are others, but these are the ones that I tend to watch the most. So the far bottom left, XLP, consumer discretionary. Think of household spending, things that people are going to buy no matter what the economy. Toilet paper, bourbon, the important things in life. The inverse of that on the other side would be consumer spending on the frivolous end. That would be in the upper right corner here. This would be your cruise lines, hotels, resorts, things of that nature. Watch the bonds. That would be ZB here. You can see that as they rally, they're putting pressure on the financials, which puts pressure on the rest of the indexes. And it's like think about it holding a balloon under the water. Your pressure and your energy is keeping the balloon down there, but when you let off on the energy that you're putting out, the energy that it is gathered will buoy it back up again. So when you see the bonds rallying to the upside like that, think of the bonds putting pressure on that balloon and pushing it down under the water. That would be pushing against the financials. I used to believe that the bonds were inverse of the marketplace, and that's not exactly true. And Tastyworks did a really, really good video series on explaining that it is not a correlated or inverse market, and that it actually changes through the years. And there's times when it's correlated, and then there are times when it's inverse of each other. And it's your job to recognize when it's one or when it's the other. That white angled line is a linear regression. It's an indicator that is standard on Thinkorswim. You need to be very careful with it. It counts how many candles are on the chart. So if you're on a 5-day, 5-minute chart, it will look completely different than if you go to a 1-day, 5-minute chart. It doesn't matter which one you use. Just be consistent with it so that it gives you a continuous standard reading every time that you use it. See that the VIX is still up a little bit. And I did mention we are in backwardation. Backwardation is when the front series or front contracts or front dated things are more expensive than the farther out things. Right? Those things can be anything that has a date and a price tag connected to that date. It can be yield curve. It can be options. It can be futures contracts. Anything that is dated and has a price tag connected to it will run in contango, which is what we normally see. And when we are no longer in contango, then we get into backwardation. This is a really great example of exactly what I'm talking about. Here's the active contracts in the futures market, $27.40 for a 16-day. And if you go out to, we don't have a 50, but we do have a 44. If you look at the 44 contracts, they're running at $23, right? So This is backwardation. Contango would be when the 16 dated options or contracts are $23 and the back ones would be 27. That would be what our normal marketplace would look like. This is a very good way to recognize how much uncertainty, fear, greed, whatever is in the marketplace. Think about buying insurance. Uh, if your focus for your insurance premiums is on the immediate future rather than farther out in time, it shows where your concerns are really focused. All right, what you got, people? You want me to look at anything in particulars? Or are we just assessing the market looking for an opportunity still? Jump over and take a look at the S&Ps while I wait for an answer to that. We are back in the cog lines, by the way. For those of you who are not familiar with cog lines, these are center of gravity. Their name implies exactly what they do. They draw price to them. And the way that we use them is a lot like Fibonacci. So when we break and close below a cog line, it opens the next one down, and we are headed to that next one. It's like fate, kismet. KPTI called out in the chat room. Therapeutics. This thing has gone silly. What do you do with something like this? It's breaking all boundaries. It's gone parabolic. It does not match any price pattern other than a very unstable bull flag. And what I mean by unstable is when a market works its way up, it has support underneath it. When a market goes like this and runs parabolic, it creates a liquidity vacuum underneath it. There's nothing there, which means when it hits any kind of resistance, it's more than likely going to rebound right off of it. There's no structure to it. If you didn't already get it when the getting was good, you're going to need to wait for an opportunity to get in. Oh, goodness. Come on, Thinkorswim. So it looks like it started before market open, and now they're just waiting on the suckers to jump in. You do have a really great, what do they call this, open range. So the good thing is you can set an alert on Thinkorswim and look for a breakout of the range. It's not a bad range either, so you could look to trade inside of it, just trading reversal patterns again and again, rather than waiting for the breakout. Doesn't really matter which one you do. The breakout seems to be forming now. It's got a lot of pressure here at that 24.5. Recognize that that is a quarter level, and that is where a lot of resting orders are at. So every time it gets up there, it's hitting people's sell orders and probably some buy orders too. There's always somebody who thinks that it's going to break out again. A market like this, you will probably not get more than one good bull flag. So if you get one flag today on the intraday, take it and run. Be cautious if you see another one. No, I'm not. I shut down every long position last week, and I was okay with that. I don't see this market recovering, and I closed down everything that was long. I'd rather take my lumps. And even after closing those longs, the account is still up on the year because I had 2 hedges in place. When this market took a turd last week, it activated those hedges, the risk twist spreads, and they paid me out not as good as I would have liked because they had already moved too far past their due date for when we would normally have gotten out of them. But they were still more than 100% profitable, more than enough to cover the losses from my long SPY trade, my Boeing trade, and I actually got out of Microsoft with a scratch. So I'll take scratch over loss any day. And I don't have any new hedges because we can't get into hedges at this time. So the only play that is left to us is to take the VIX short, which we did Friday. And I don't want to jinx it, but I haven't lost a VIX trade yet. Of course, there's a first time for everything, and sooner or later I am going to lose one, but not yet. Nike's got a really high sizzle this morning. Go take a peek at Nike. Look at the basing pattern that it's forming. Nike is one of those companies that I'm really wanting to keep an eye on the news. I want to see them discuss their supply chain. I want to see them discuss their forward guidance. For those of you who don't know, I worked last year for a little bit at Foot Locker Distribution here in Kansas, and I was hired to reconstruct their hiring processes, and then that all fell apart, and they ended up putting me in a labor position, and I bailed out of that mess. Can you go long in TVIX? If you want to day trade it, I certainly wouldn't poo-poo on the idea of day trading this, but this is not something that you're going to want to swing trade. Good morning, Trevor. Rezik, the reason that I recommend that people don't try to swing trade TVIX is it's not a typical, it's not the VIX, okay? And it is owned by Credit Suisse, and Credit Suisse hires market authorized participants who are allowed to manipulate the price of the product and get paid to do it when they think that it's not in step with where they believe it should be. This is something that gets reset every night because it's supposed to move in a percentage basis with the rest of the market. So every evening it gets reset. You don't want to trade something that gets reset. You don't want to trade something where you don't understand its volatility calculation. And you don't want to swing trade something that has authorized market participants who are allowed to manipulate the price of it to suit their needs. Okay? With all of those in mind, you could certainly day trade it. I wouldn't poo-poo on that idea from anybody, but you wouldn't want to buy and hold or take it for a ride. All right? I know that it's a famous one that everybody really seems to focus on in the social media community. Stock Twists talks about TVIX all the time, but VIX is VIX, and this is not. So, yeah. $3M. Guess we don't need that market volume anymore. We can get rid of that. For those of you who have watched my weekend videos, you might recognize this pattern. We've got the basing formation. Now the question always comes down to, is it going to fail and form the reciprocation pattern, or is it going to continue? If it continues, then we'll be looking for the next leg down. And to get that measurement, we take it from this impulse. And then we just grab that and we set it down there. And we can identify where that next leg is at. So if it reciprocates, we're headed back up to the 184-ish, 185 range right up in here. And if it follows through, then we'll be looking for the 135 range. When it comes to trading bear flag failures, it's something that we've really been hammering out in the last few months, but that was in a very strong bull market, and we are not in that. All right, so don't believe that the pattern is going to be as effective right now as it has been, because we're no longer in that kind of marketplace. Oh, we really leaned on those broken bear flags. This is what it typically looks like when it fails, and we trade the reciprocation back up. We traded this pattern a lot, way back up again and again and again, and you take it with a target already mapped out. You know exactly where you're going because you can see where it's coming from. And it's a really great trade. But we can't count on bear flag failure as much in this market environment as we have been. Let's take a look at that gappers list and see if anything has settled out. HPI. Right now, this is drawing a line in the sand. That bull flag is either going to follow through or it's going to fail. And the failure of that will be the same trade that we've been doing on the bear side, just in reverse. Reciprocation back down to the levels. I don't believe that that's going to work out, but that's the way that the reciprocation pattern works. Liquidity. Arjun, the only advantage is liquidity. So look at VOO. Just recognize that it's owned by a different company, right? That's a Vanguard product, and SPY is owned by SPDR. Now, the way that they make it, it has a little bit of Apple, a little bit of Facebook, a little bit of Google, right? They choose, like making a cake, how many pieces of the ingredients are in there, and you can Google that. You can go to Google and type in SPY and read how much Microsoft is in it, how much Apple is in it. I don't know how often they get to restructure those ETFs, but when the market caps change, which they did last week, then it's not as balanced as, say, trading XSP, which would be something that you could afford also and wouldn't be as expensive as trying to trade SPX. This is a micro of the S&P, but it is algorithm synced perfect. It's not an ETF. It's not a man-made product with a little bit of Apple and a little bit of Microsoft. This is just algorithm synced to perfection. This would give you a greater exposure to the S&P than trying to trade something built by Vanguard or Spider or one of those other ones, right? But they're a company-owned product. The company that owns SPY is called SPDR. Once you get into the all products, you go over and look at the options chain. Recognize that the S&P has 3 expirations in a week. The XSP, unfortunately, isn't as liquid as SPY, but really, it's hard to find a lot of products as liquid as SPY. But if you go and look at something like VOO, owned by Vanguard, you notice what you see right off the bat. It doesn't even have weeklies. That should get your attention. It's not very liquid. Look at the bid-ask spread in here. This is horrible, horrible bid-ask spread. You'd get slaughtered in here. Why would you want to trade this? You wouldn't. IBV. This is owned by iShares. At least it has weeklies, but it doesn't have Monday and Wednesday like SPY does, because SPY is an experimental product. Okay. In here, we've got a very horrible bid-ask spread. That bid-ask spread comes from the fact that it's not liquid. You don't even have to bring up the volume or the open interest. You can see it right here in the amount of money between the two here. So you wouldn't want to trade this. Just back away, go back to SPY, or go to the XSP. make sure you're looking at the XSP and not the SPX. The SPX is a beast. It's a monster. It's the granddaddy. It's huge. If you're not consistently profitable or don't know if you're going to be consistently profitable at trading options, there is no reason for you to go messing with the XSP. This $3,000 product. It'll chew you up and spit you out. Just to avoid this, especially if you're running small accounts. The main thing that should get your attention is the idea that that was, quote, very helpful. That shows that you have a long ways to go with your options education. And the good thing is we've got a lot of material to help you with that. No, Bond, there's no edge. There's no directional edge in bid-ask spread of that width. If we go back to that junk, which one were those? VOO. It's a very wide bid-ask spread because there's not a lot of people trading it. All right? Since there's not a lot of people trading it, there's not a lot of offers, and the bids get farther and farther and farther apart. That doesn't imply any directionality at all. It just implies that not very many people are trading it. Now, using a product like this to infer what is going on in the marketplace, there's absolutely nothing wrong with that. Last year, Dan and I was comparing the sectors that we both watch. He watches a group of ETFs that are owned by a company different than the ones that I watch. And yet both of us are still watching the same sectors, right? We're watching real estate, banks, building materials, railroad, shipping. We're watching the same things. We're just watching it from different company-made products, right? We have no intention of trading those ETFs. Rather, we're just using them like Dow theory to keep track of what's going on in transportation and rail and shipping and blah, 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 right? So if you was to use Vanguard S&P 500 VOO to monitor the marketplace, to kind of get a feel for what's going on in the market, there'd be nothing wrong with that whatsoever. It's not a bad product. It's just not something you want to trade, right? FTSV. These guys got news because of the buyout offer from Gilead Sciences. 47 Incorporated is going to be bought for $4.9 billion. Yow. Good times, huh? Trillium Therapeutics. This is a Gilligan's Island reversal. You can read about that at Swing Trade Bots. And I believe it comes from the book Hit and Run Trading. Maybe Hit and Run Trading Part 2. Either way, it's an island reversal that they nicknamed the Gilligan's Island reversal. I don't know why they put Gilligan's name on it. But one way that you can trade this, well, okay, you won't be able to do it on Trillium, is that you would put on a back ratio on the call side, but Trillium just doesn't have the options structured for that. It's just, you're not going to be able to do that. See if we got anything with some decent beta that we can play with. AHPI. Guys, this one's setting up for an opportunity here. Look left to Friday's low. If this breaks and closes below Friday's low, this is going to be a big neon sign into the marketplace that says, short me now, please. Make sure that it gets its follow through before you get in. And one of the things that you can look for with that follow through would be a Busby. I don't know what else to call it, so I've named it the Busby. The Busby is when a market finds resistance, fights, and breaks through it. And then after it breaks through, it comes back and validates that resistance as its new support. So in a trade like this, if you wait for it to break below structure at that $15 level, let it run for a moment, give it the opportunity to pull back, test that previous resistance as its new support, and then get into the trade and take it for a ride. Now, obviously, this is not to scale because I've got log on. You wouldn't want to wait for that kind of move, but that's the pattern that you're looking for, right? The Busby. You're looking for the pullback to structure to give you that opportunity to go. Either way, the break and close below Friday's level is going to be your big neon sign. The nice thing is you can just set an alert on that and go do something else so that you're not just sitting there babysitting it. APT, another one with a high beta, 14. Wow. This one is also right at structure from Friday's levels. Need to see it break and close below that structure. Follow it back another day. That was Thursday's structure. Same spot, same situation. And follow it back into the pre-market for even a little bit more. Oh, PMI miss. Transplant, thank you for giving us that shout out. Once I'm streaming, I turn off all the news services, so I have no idea what is going on when it comes to media and marketplace. I appreciate that a lot. Thank you. And Bear says ISM missed too. Right on, right on. IBIO. So, sounds like an old McDonald's farm. Green on the screen, up 8% still this morning. 8%. This is pressing to the low side of its open range. If it fails and breaks that open range, look for the pre-market to provide its next level. It's another one that you could just set an alert on. No reason to babysit. VIR. Oh, it did. It did break. Did it? Let's see. No. It actually held Friday's level so far. Just barely. Oh boy. Another one you could set an alert on. The marketplace is unusually quiet. It's very odd. I've been watching the futures, and maybe it's just because of how spoiled I got last week, where the NASDAQ was moving a quarter in, a minute and a half. 5-minute candles were moving from 25 points at a time. Maybe it's just I got spoiled from that, but the futures are unusually calm at the moment. It makes me nervous to be just flat honest about it. Of course, I'm not in any position to get hurt, so it doesn't matter to me which way it goes. Creed with his funnies. So I'm looking at the sectors here. A lot of weakness and just all around there. Nothing here. Spread that out a little bit and take a bigger picture. kind of zoom in here with the bonds. Yeah. So we got nothing. Consumer spending here on the XLP is the only one showed a little bit of gumption at all, and it's flat. It made that range up and it stalled out. The utilities, XLU, I wouldn't say it made the same range. It did give a little bit of a run up, but it's giving it back and it's on the march. Clean that up a little bit, make it easier to see. So XLI is one of my favorites. It gets overlooked a lot. It's not sexy and exciting. It's not one of those ETFs that everybody talks about, but its influence in the marketplace is extraordinary, and we need it to get into the game, to get off the bench. You know, they talk about in football that a really good quarterback isn't worth spit if he doesn't have anybody protecting him, right? It takes a team effort. Well, these sectors, no one single sector is going to be able to get the job done. There we go. That's bringing things into focus. Better than those dark charts with the grids on there. Couldn't see anything. On XLF, 26.5 is a level drawn in the sand by Don Kaufman, I believe a year and a half ago, maybe almost 2 years. We'd have to go and look at the chart for sure, but he definitely made that his sweet spot, and he did point out in the weekend videos that we were back to those levels. Now, I heard from Bloomberg that WHO won't use the word pandemic. Is that what you just shared right there? Did they use the word pandemic in that video? I'm just curious personally, because the idea that they wouldn't call a pandemic by the name, you know, or infer that something is a pandemic is was an interesting perspective. Aha, yeah. It looks like the Russell is taking us under pressure. That would be the small caps. For those of you who might not have seen, this is what I use to look at the market to do everything. When I'm trading, no matter what it is that I'm trading, watching the market using this setup. And the market passes back and forth who is leading and who is following. There's not one clear leader through the day. At different times and for different reasons, one will take the lead. What I look for is market sync. One of the easiest ways to trade or to even monitor the market in a grid like this is to pick a candle. You want to see your mouse work on all four grids. And then when you pick a pivot or a candle and you stop there, you can see it on all four markets. Choose one, and that'll be your identifying structure. And then work your way through the four from there, drawing your setups and looking for your entries and exits. In the current situation, what I'm looking at is this Globex pivot point on all four markets. I'm going to make that bigger so you can see it in the stream. Give it a brighter color. So that line in the sand, that's what we want to see. We need unity. We need market sync. Otherwise, we're just going to continue to range around and get nowhere. So for this sync to work out, after the Russell gets down into this range, and it seems like it's going to get there before everybody else does, it needs to maintain and hold that range, kind of bounce around while the others work their way down to that same level. From there, we'll have sync, and then either begin the march back to the upside, or we could really just range around half the day. I don't know, but I'm still looking for sync, and that's where I'm looking for it to begin. There you go, Bond. I wondered what their stance was on that. It was just interesting when I was listening to Bloomberg that they said, well, you won't hear the WHO organization call a pandemic. And when they said that, I asked myself, like, why would we never hear the organization ever come out with such a thing? And that makes perfect sense. So thank you for sharing that. Appreciate it. Well, there you go. Well, let's jump through a little bit and find perhaps another opportunity. It was interesting over the weekend hearing that they almost put out a rate cut Friday, and at the last minute they decided not to. I was really surprised when I heard that. We are right between 0 and negative 100. That is the sweet spot for bearish market activity. And we just spiked into the extreme up to 1,000 in the ticks. That is a market pause or market reversal signal. So be aware of that. A market pause does not mean reversal. So don't see something like a 1,000 tick and immediately try to pull the trigger to go in the other direction. It's a bad idea. Instead, let that be a warning for you to get risk out of the trade, perhaps pull some profit off the table. And I could have swore I see news that Apple had gotten downgraded at the same time that I heard somewhere else that they got upgraded. So a bit of conflicting news from that end. I've been very open about where I believe that the market is going to go. 2,500 on the S&P is my target, and I'm okay with being wrong, but that's where I'm looking for the market to go. I know in the last week or two, Microsoft and Apple have passed the baton back and forth on who is the leading market cap. That's been interesting. I think that because of liquidity pools. So let's discuss last night's price activity, since we were discussing this in the Discord this morning. I went to bed before the kill zone last night, so I didn't get to trade it. Think of Friday's price action. Okay, so in Friday's price action, you had this as your area of where there was a lot of resting orders. And what we expect the price to do before it continues lower is we expect to see a market come up and get those, collect that pool of liquidity, and then carry it down, right? They need people who are selling, so they want those orders. So they run sideways like this, causes a draw. They make a run up, they get it, they take a run down. Okay, well, put that on a bigger picture. Instead of it just being in the overnight and the Globex in this small little range, put it out on the big picture. Look at where we're at overall from the large perspective. Come on, Thinkorswim. There it goes. 2,500. I guess it'd be better to look at it on a weekly. So that yellow bar is 2,500. That's the next targeted pool of liquidity. Now recognize there's going to be a pool here, but I don't think that they're going to be satisfied with that. I think they're going to want more. And that the next level of liquidity would be there. And if things got really, really wild, then it would be underneath that. But I don't expect that yet. I'm not calling for that 2,300 range or the 2,200. Not calling that. But 25? Yeah. If you transverse those numbers from the ES to SPY, recognize that they're kissing cousins, right? They're brothers of another mother. So here's your SPY, here's the S&P. Just move the decimal point over. They're not going to be perfectly algorithm synced, but recognize 2953, 2955. Well, that's very, very close, right? Just move the decimals. These are in sync because it's the S&P, right? Now, SPY is a man-made product like we were talking about earlier. It's owned by a company called Spiders. They decide how much Facebook or Apple or Amazon or Microsoft is tucked into that product, but at the end of the day, they're trying to mimic this. They're trying to mimic the S&P, right? So they're not going to be lockstep perfect, but if you see that the ES futures are at 29.58, you should already know that SPY is somewhere around 29.58 or 29.61 or somewhere very close to that. So you're greatly disliking Disney because you got your butt kicked? If I was to greatly dislike things that's kicked my butt, I wouldn't have anything left to trade. Get your emotions out of it and be a trader and not just someone who's donating money to the marketplace. Learn your lesson from Disney, whatever lesson there is to learn, so that your loss is not a loss, and rather it's just you making a payment on a lesson learned. We all lose. The difference between a loser and somebody who gets something from the loss is the fact that you turned that loss into an educational experience. So you either get something out of it or you donated your money. Tuition. Bond is exactly right. That's the word I was looking for. Tuition. So here is Disney. Notice that it closed the gap. And if you have not watched Lucian's video where he talks about gaps, he says it and he says it and he says it. A market wants to close the gap. It's what it does. Eventually, sooner or later, it wants to close the gap. That was very loud. So if we look at Disney and we back it up into a higher time frame, let's take a 5-year weekly. Where's the liquidity pool in Disney? Where are all the resting orders? You know it's underneath that 107. Where do I think Disney is going? Below 107. Well, John, we can laugh or we can cry, right? So we might as well laugh. All right, I got to take a moment and kill the YouTube live stream. Hello, everybody over here on YouTube. I want to, yet again, one more time, invite you to stop by the Bullish Bears, sign up for our 14-day trial, and think of it like this. You can sign up for an educational company like the Bullish Bears, and you could spend $100 a year, maybe. I don't know what our fees are. Honestly, I don't. But you could spend a little money and learn something that you can carry with you for the rest of your life. Or you can continue to trade with no education and give away money and never get anything in return. Right? So come on by, sign up for the 14-day trial. We call out enough trades in the week that will easily pay for your subscription. And I look forward to seeing you there. And I'm going to shut down the stream now. So come on over, jump into our chat room.